All right, let's dive into a token that's got everyone talking. Monad, or MON. It's presenting traders with that classic crypto dilemma. Do you chase the pump and jump on the rocket ship? Or do you stand back and wait on the launch pad? With its price just absolutely exploding, that's the big question. So today, we're going to break down the data and see what the smart money might be doing.
First up, just look at this number. This is what's causing all the fuss. A massive 60.7% surge in just 1 week. I mean, that is some serious momentum. And you know what that does? It triggers a huge case of FOMO, that fear of missing out.
And the scale of this is just staggering. We're talking about over $1 billion in trading volume in a single 24-hour period. Now, to put that into perspective, the daily trading volume is more than double the coin's entire market cap. This tells you right away, this is not a bunch of small retail traders. This is a huge sign that the major players are at the table.
Which, of course, brings us to the million-dollar question, the one that every single trader is asking themselves right now. Are we too late? Did we miss the boat on this one? Or is this rocket just getting fueled up for an even bigger launch? Let's unpack the data and find out. So, let's not beat around the bush. Based on all the analysis, what's the verdict? What should you actually do right now? Buy? Wait? Let's get straight to it. And the verdict is crystal clear. Wait for a dip. Buying in at this price, right after a huge run-up like this, is considered a really high-risk move. You know, in trader speak, they call this buying the local top, and it's pretty much a textbook way to lose your money fast. The strong recommendation here is patience. Okay, so why wait? Why be patient? Well, to get that, we first have to understand what's actually fueling this fire in the first place. Let's take a look at the anatomy of this massive crypto pump. It really comes down to a perfect storm of three things. First, you've got the listing effect. It gets listed on big exchanges, which brings in huge volume from market makers. Second, the circulating supply is tiny. Only about 10.8% of the tokens are even on the market, so any new demand just sends the price soaring. And third, you've got the story, the narrative. MON is being hyped as the next Solana killer, and that's a story that always gets speculators really excited. And if you're wondering who's behind that $1 billion in volume, well, the analysis is pretty blunt about it. Quote, "This is not retail. This is market makers plus whales." What that means is the big money is running the show here. They're creating the hype, they're providing the liquidity, all to attract smaller buyers before, potentially selling into all that excitement. But that kind of whale activity, well, that leads us directly to the risk side of the equation. Because underneath all this exciting price action, there are some pretty significant dangers lurking that you need to be aware of.
Okay, so remember we said only about 11% of the supply is actually out there? Well, look at this. That means almost 90% of all Monad tokens are locked up, just waiting to be released onto the market in the future. These are called token unlocks, and they are a guaranteed source of selling pressure and major volatility down the line. It's a ticking time bomb, really.
And here is another massive red flag. The current market cap is sitting around $500 million, but its fully diluted valuation, that's the value if all the tokens were out today, is a jaw-dropping $4.6 billion. That nearly 10 times gap is a huge signal that the current price is pretty inflated, mostly because the vast majority of the supply hasn't even hit the market yet. So let's actually put some numbers on these dangers. First up, the volatility risk. It scores an extremely high 9 out of 10. Yeah, 9. And that's driven by that tiny supply and all the intense speculation we've been talking about. On top of that, you've got the risk of whale manipulation. That comes in at an 8 out of 10. With so much of the trading volume controlled by these big players, the price can be pushed around so easily, and it's the smaller traders who get caught in the waves. And finally, the risk that you're just buying the absolute peak of the speculative pump, that also scores a 9 out of 10. This goes right back to that danger of getting caught buying the local top. You add all of that up, and what do you get? You get an overall risk score of 7.9 out of 10. That is firmly in the high-risk category. And it's the final data-backed reason for that wait for a dip strategy.
But listen, waiting doesn't mean ignoring. Not at all. The analysis actually provides a super clear, actionable trading plan for the next 7 days. So let's break that down.
So you basically have two options here. Strategy A, which is the recommended one, offers the best risk to reward. It's to buy the dip. You're looking for an entry between 3.8 and 4.1 cents. That's considered a key accumulation zone where buyers are likely to show up. Now, strategy B is a bit more aggressive. Buy the breakout. This means you only get in if the price pushes above 5 cents and closes there with high volume, which would signal that the momentum is actually continuing upwards.
Oh, and before we wrap up, just a quick but really important note on the currency here. All of the price targets we've mentioned are in US dollars. So for our viewers in Canada, just as a heads up, that 4-cent target is roughly 5.5 cents Canadian. Okay, good. Let's bring it all home.
So, there you have it. The analysis is clear, the trading plan is laid out, the data says be patient, wait for a better entry. But in the end, the final question always comes back to you. Now that you have the data, the real question is, how much risk are you willing to take?